I've been trading the carry strategy for the last 3 months, and in that time I've earned a 26% return just from collecting interest on commodities. This is passive income. I open positions and I hold them long term while the interest payments accumulate. Today, I'm going to break down exactly how this works, how I trade it, and I'll walk through some of the risks involved as well. This is my own testing and results. It's not trading advice. I'm just sharing what I've learned so far. So what actually is the carry trade? Carry trading is usually associated with Forex. So let me start there with an example. Here I've got a chart of the dollar yen, which is a very popular and well-known carry trade cross. But before I even look at carry, let's understand how this works in the background. Let's say that I go long 100 units of dollar yen at a price of 150, way down here. What does that actually mean? Well, it means that I'm using Japanese yen to buy 100 US dollars. And because it costs 150 yen to buy $1 at this rate, this transaction is going to cost me 150 multiplied by 100, which is 15,000 yen. And that's what happened if I had gone long at a price of 150. But my trading account is in pound sterling. So where do these yen come from? And how is it that I can even have that many? Well, that's the core of retail Forex. In theory, when I go long on this transaction, I'm actually borrowing the yen from my broker. And then I'm using that yen to buy these $100. The broker allows me to borrow a large amount using leverage, which means that I can actually trade with more than what I have in my account. All I have to do is place a small deposit called a margin. And this is what is meant by leverage and margin rates, like 20-1 or 10-1. These are the ratios at which I'm allowed to leverage. And it will shortly become clear how that relates to carry. But let's say that position from earlier that I bought at 150 has now gone in my favor, price has increased, and I decided to sell at 151. What happens there? I still have my 100 US dollars from before, but now they're worth 15,100 yen because the price has increased slightly. I sell my position and I'm left with this many yen. I then return the 15,000 that I borrowed from my broker, and I'm left with the 100 yen profit. This is converted into my own currency, which in my case is British pound, and that is how I would make a profit on the price moving from 150 to 151. So what does any of this actually have to do with the carry trade? Well, if we go back to how the transaction started, for me to have bought those $100, I had to borrow 15,000 yen from my broker. But I don't get them for free. I have to pay interest on this, just like on any other loan. The interest is guided by the central bank rate for that currency, and for the yen, that is currently 0.5%. But I use those yen to buy US dollars, which I now hold as an asset, and that earns interest, just like money held in an interest-paying bank account. The rate for dollars is set by the Federal Reserve, and right now that sits around 4.25%. I'm effectively borrowing money at a lower rate of 0.5%, and I invest that in an asset, the US dollar, which pays a higher rate of interest. As a result, I get to pocket the difference between these two rates. That difference works out to be 3.75%. And that is in essence the carry trade. I hold a long-term position and I collect these interest payments. In practice, these are referred to as rollover or swap. It really just depends on the broker, and it's paid for holding the position overnight. The dollar yen is one of the most popular instruments used for the carry trade, but it's not the only one. My broker, in this case Owanda, provides a table that has all of the different instruments that they offer. And in this table, they show the annualized long rate and the short rate. And if I bring up the dollar yen cross right at the bottom, we can see what I spoke about earlier. If I'm long on this currency pair, then I get paid 2.77%. Notice how this amount isn't as generous as what I had calculated earlier, which was 3.75. That's because the broker will take their cut. So the rate I actually get in the end is always worse as a result. There is also financing in the short direction, but this time it's negative. And this makes sense because I would now be doing the opposite trade. If I'm going short, then I'm actually borrowing US dollars in order to buy Japanese yen. So I'm borrowing at the higher rate and I'm earning at the lower rate, which is why it becomes a negative carry. Most of the time the rates tend to be negative, and when they are positive, they're a lot smaller. This isn't necessarily an issue because the carry trade is supposed to be a long-term strategy. If I head over to currencies and I sort this by the biggest number, you can see that the highest rates actually come from the exotic pairs. In this case, the Turkish lira versus the Japanese yen in the long direction. In the short direction, again, it's the Turkish lira that's involved in both of the highest paying rates. But that pair is so volatile that Owanda won't even let me trade it. This table has rates for everything that Oanda offers. There's currencies, metals, indices, even crypto and shares. But I was specifically drawn to commodities, especially oil and natural gas. There are two instruments for oil with Oanda. There's West Texas and Brent. Right now, neither of them is paying a particularly high carry, but they were previously a lot higher than this. Natural gas, however, is paying a very high rate in a short direction, but this also fluctuates a lot. These instruments work differently to the Forex pairs, because here I'm not borrowing one currency against another. So the financing rate is actually coming from things like supply and demand, seasonal factors, storage costs, etc. As a result, these rates can be much more volatile, and they will change very quickly. But when they are favorable, they can pay a much higher amount. And this brings me on to risk. Collecting financing seems like free money, but it comes with significant downsides. First, like I said, the rates aren't steady. If we look at natural gas, right now it's 96.8%, but if I was to go back, say, a few months, then the rate is completely flipped, and it actually is negative in the short direction, and it pays in a long direction. So if I accumulated long positions, and then the next day the rate suddenly flipped, then I would be paying this high rate of financing instead of earning it. And the second major risk is price swings, which can completely wipe out any profits from carry. This chart of natural gas shows how much prices can move up or down, depending on what's happening in the world. If I had gone into natural gas in a short position somewhere here to collect the carry, and price rallied up against me like this, then I could end up taking a loss that completely negates any interest that I earn. Managing that risk is crucial, and the way I do that is through position sizing. The rates being percentages means that the amount I get paid or charged depends on the value of my overall position. And in fact, over on the right hand side, I can see the long and short cost in dollar terms. And the notes below explain that this value here is based on having 100 units of a commodity. So if I'm short 100 units of natural gas, then I will earn 88 cents per day. But retail brokers, like we talked earlier, allow trading with leverage using margin. So I could increase my position tenfold and instead buy 1,000 units. Well, that's going to multiply this by 10 and suddenly I'm earning $8.80 per day. But here's the problem. The bigger the position, the bigger the effect of price movement will be. I need to avoid being greedy and look for a balance between earning enough from the carry to make it worthwhile, but also not risking so much that I blow my account. The carry strategy is a long-term approach. It isn't something to trade daily. Therefore, I need to look at prices on a higher time frame to understand where I am relative to where prices can be and where they have been. When it comes to working out the position sizes, I use the spreadsheet that I've created. I start by populating my balance. This doesn't include any open positions because that changes on a daily basis, whereas this is the actual balance that I've earned from my carry trade. I also record how many instruments I'm trading at a time so that I can divide my portfolio accordingly. Right now I'm trading Brent and natural gas. So down here is the instrument, and next to it is the amount of balance that I'm allocating to that instrument, which is just my overall balance divided by 2. I get the swap rate from that financing table on Oanda's website, but that number is an annual rate, so I divide it by 365, which gives me a daily rate. From that, I can work out how much I will earn every day from this carry, and that tells me whether or not it's actually worth the risk. But this alone doesn't tell me how much I'm actually risking. So I created my own rule for this. If I'm risking £68 on this Brent position, then the maximum that I want to lose on it is half of that position, which is this £33.82. I take into account my leverage, work out the position size that gives me, and then from that, I can see how many units I need to buy. But not only that, I can then see how many pips the price would have to move against me in order for me to lose 50% of my position. So basically to lose £34, i.e. half of this amount here. From that, I can create a virtual stop loss, which is basically the price at which that 50% loss will come. I then head back over to my chart where I've taken my long positions already, but I've now drawn that 50% line. So if price was to drop to this green line down here, then I would lose half of my position on Brent crude. Not half of my overall account, but just half of this position. On this time frame, that doesn't look so bad, and it seems like it's not a price that's ever going to get hit. But realistically, I need to look a lot more long term than that. So on the weekly, if I zoom back out and I reset the scaling, I can see that price has been at those levels before. So there's definitely a possibility that it could get hit. But at least this gives me a visual indication of my risk, and that way I can decide whether it's worth the potential return that I could get from this carry. The best outcome for me would be the prices increase. That way, not only do I earn money from the carry, but I also make a profit on the position itself. But the second best outcome would be the prices just stay horizontal. They go sideways for weeks and weeks on end. My floating P&L will just fluctuate, but my carry will pay every single day. I also don't have to accept this 50% position. This was a personal choice and it's my own risk tolerance. I could increase my position size and move this line a lot closer. This means that I wouldn't be able to tolerate as much price movement, but I would earn more per day. Likewise, I could move the line further away, reduce my overall position size, and be really confident that I'm probably not going to get hit on that stop loss. But then the amount that I'm going to be earning per day is going to be so small that it might not be worthwhile. So for each trader, this level of risk versus reward is a personal preference and it's up to their own risk tolerance. As I earn more and more carry, this balance increases, which actually means that over time, the amount of units that I can afford increases as well. And this is where compounding can come into it and really take this strategy to the next level. If I reinvest this daily carry into buying more positions, then my account size gets bigger and I earn more daily carry. And this turns into a positive cycle. However, I don't want to rebalance all the time because prices are going to fluctuate a lot and I'll have to pay spread each time I do this. What I've been doing is rebalancing at the end of every month. And I've found that to give me a good balance of reinvesting my profits while also not paying too much in transaction fees. So that's how I've been approaching the carry trade over the last 3 months. The strategy isn't difficult to follow, but it is very risky and things can go south quickly. I trade with a small balance, making sure that I only risk what I can afford to lose. I make monthly recap videos on this strategy, so make sure to hit subscribe to avoid missing those videos. Thanks for watching.